Hey there, welcome back to the channel. So I want to make a little video. It's sort of in response to one of the YouTubers out there who's been doing a lot of stock trading. And it was the Kev dude. And, he's talking about his margin and how, he has to do some selling because, and what his plan is for, lowering the margin. And then the other thing he was saying was like, he doesn't look at his account balance because it just messes you up psychologically. It's like, I, I, I was watching this video and I was just thinking to myself, I'm like, wow, I'm watching a person blow out their account like in real time. I'm like, you've got to be kidding me. I mean, if it's just incredible to see. So let me just show something here. It's just amazing how bad the advice being given is. Now, this is not financial advice. This is, I'm not a financial planner, go do your own thing. But okay, the guy's talking about margin, all this stuff. And now he's finally after today, he owns like a bunch of stocks like NEO and this other crap that are down 10% today. And of course, the margin percentage in his account is going up. It's getting to like 23, 25%. He's trying to keep it down to 20%. He doesn't look at the losses to see how much he's actually lost. Then he's been buying this whole time. He's been buying the dip, and now he's got no money left to buy any more of the dip. And then this is the position you're in. Now, here's how this works so you understand. Like, people don't understand this. It's like you're in this position and you're thinking like, oh, well, now I think it's going to be a double dip here, and then it'd be a W. Well, how can you say that? You cannot say that. There is nothing that that's all pure speculation. So there's no way you can say that. This is one of the things with technical analysis, charting, and patterns. When you're looking at patterns, which you should kind of learn about them, but they don't necessarily work that well. One of the things that you learn is like, hey, you can't try to predict the pattern before the pattern happens. And so some patterns are better than others because some patterns, it's like, oh yeah, by the time you get confirmation that your pattern was there, you're not in a position to make any money. I mean, it's not easy. This stuff isn't easy. So the thing is here, how can you sit there with this relatively high volume sell-off day, 10% down, and let's go to the NASDAQ here. You can't say that it's going to be a double bottom. You can't say that. You can't say that it's going to stop going down here, come back up, and then everything's going to be hunky-dory. And I found it really interesting because, he's coming up with his plan for what he's going to sell. And apparently it's like, okay, get some cash, do this, do that. Then it's Bitcoin. Bitcoin's gone. Okay. And then it's going to be some of the other stocks, going through the list, because what's going to happen? He's going to have to put money in the account. Right? You either have to put money in the account or you have to sell. If the value of the stocks that you're using as collateral for the money you borrowed, which is margin, the money, if the value of that stock goes down too much, then they want you to add more stock or add more money because they want at least a minimum of that 50%, meaning that if they lent you $1 million, they want you to have, 2 million worth of value in that account. And so, it's interesting. So he's talking about like how Bitcoin is going to be the one to go, and then followed by Apple and some other stocks. And see, here's the thing. Then you come over here, oh, and I'm not paper hands and whatever. But you see, this is where it already could be happening to other people. Everyone's got themselves in a different little place. They've got themselves on margin. They're over levered into stocks that are very volatile, that have that may be like valuable companies a few years from now, but right now it's all just pure speculation. And if you're over here and you're planning like, oh geez, I need to like get rid of some of my margin because I might get an actual margin call, which it can literally be a phone call, what makes you think that's not already happening to people up here? So you're sitting out there, you like, buy the dip. Why are people selling? These people are stupid for selling. Well, they don't have a choice. Just like this guy doesn't have a choice. You already had people that maybe were on margin and like, okay, I got to get rid of this stuff. So the point is that you can't predict what this is going to do. You can't predict that it's going to hold the line. You can't going to predict that it's going to hold the 200-day or hold this other low. There's no freaking way. And when you do that, because what you're doing is you're picking, if you're doing that, you're saying, oh, I'm picking a bottom. That's what you're doing. You're in a short-term downtrend and you're trying to pick a bottom. And that's a reasonable place to look for it. Sure, at the moving average, whatever, but there's no guarantee. Support isn't like a concrete wall. Support is more like a creaky wood floor. That's what it is. All support eventually gets broken, and all resistance also generally sort of can get broken. So this is something to be very careful with. My guess is if you're looking, I'm looking at this guy and this guy's like getting over leveraged. My guess is he's not alone. Because there's like look at ARK Invest, because think about like here's the ETF, the ARK Innovation ETF. So what is Cathie Wood doing? Well, Cathie Wood's got herself in a pickle, right? She's got these losses over here. She's got Tesla, which is levered to Bitcoin. She's got Bitcoin. She's got all these stocks that are all these high beta stocks. And she gets redemption. She's going to sell. Maybe she'll beat you to the punch, Kevin. She'll unload before you do on some of this stuff. So what I'm saying is it seems to be really bad advice out there. Really, really bad advice. And I would just urge caution. I don't have advice to give you. I'm not giving you financial advice. I'm just saying when I see this stuff, you really need to, I would just strongly suggest do your own research and look at it because, if you go out in time and you go out and what happened here, there's no reason. And the other thing is like, they talk about how it's like, people will talk about how there's no reason to be selling. The interest rates are not going up that much. The interest rate isn't a problem. The economy is okay. The Fed says inflation is going to be low. All this stuff, and none of it has literally any bearing on it. Like if you just have a bunch of people with a bunch of margin that need to lower their margin, you're going to get selling. It's just, or you get a bunch of people that want to press the sell button for whatever reason, you're going to get selling. So, you have to understand behind the scenes, there's stuff that, stuff happens and you don't always have a reason for it. And you have to kind of accept that. So you have to just, at some point, you got to just kind of, you got to sort of like understand this is what the charts are doing. This is what they're doing. And you kind of have to deal with what you have instead of your own speculations. And it's your speculations and your biases. That's what it is. And that's what gets you. And it's really amazing because I'm just watching a guy that I suspect he's blowing out right now. And it's really quite amazing to watch. It's funny because you zoom out to the big chart, like here's 2000. This run up in 2000 was bigger than the one we're in now. It was just straight up, except for some consolidation there. And it imploded. And it's funny because people don't, I don't know, people don't look at this or think about this, but you have to understand, if you're over here, and this thing is just boop, going up, this is a huge loss. You're at 5,000, you're down here, you're below 2,500 is right about here. So at this point, within that period of time, you lost half in your NASDAQ stocks. And the other thing to keep in mind that this serious crash happened really quickly in a matter of, whatever, these are weekly bars, matter of a few weeks. But then you had this losing consolidation period for another 6-8 months, and then it went down even lower. So you have to understand if you're what is going on right now. People are in Neo and Enphase and all these stupid companies, and they're buying the dip, all in these big bars. And yeah, maybe you're going to get a pump up and maybe it will recover, and that's fine, but you got to have some discipline because there's nothing different today. There's nothing different today And if you believe that there's something different today, some reason that the market can't take a 50% tumble, then that's just speculation. The reality is the market do whatever it wants whenever it wants to do it. You know, here it was 5,000. It's so like really understand what happened to NASDAQ. You know, here it is in March of 2000. Here we are. It's a whole year later. And then we have September 11th, sure, but September 11th was like right over here. And remember that was the like a low, in medium term low, but we had already taken a lot of damage. So, you know, you got to understand. So just take 9/11 out of that. You know, you got to deal with something for 2 years of declining markets, and you just cannot survive buying the dip on that. And the only way that, you know, people like Kev are going to learn is they're going to get wiped out. Now, are they going to get wiped out now? I don't think so. I mean, I think that they will get away with it for a long time, you know, and that's fine. I'm happy for them. But like, if you're listening to this stuff, you got to have some discipline. You got to, you know, you can't just, you cannot be in all these kind of stocks. All these, when you go and you look at a 3-month chart and you're like, there's NEO. Okay, it's got the same pattern, the same decline, failed to get above the 21-day declining below the thing. You look at that, and then you look at Tesla, same chart. And then you look at end phase, same chart. You look at NASDAQ as a whole is going to be a little better, but it's almost the same chart. Right? So you have stock after stock correlated with each other, trading with each other, getting sold off. At the same time that the SPY sold off a little bit, but not that much. So, yeah, so I think that's all I have to say. Just, you know, be careful. I think that, well, one more thing. The other thing where I think things are very disingenuous, and where is the math being done? See, because here's the thing. If you're not looking at your balance, then you're not looking at profit and loss on each trade. You know, you need to look at profit and loss on each trade. You know, if you're not doing that, you're lying to yourself, and you're not actually going to be a trader that's going to last very long. You know, so here, for example, GME put here, I mark when I bought the put and when I sold the put. And here I bought this put. It was a 120 April 16th that I sold too early. I've made many mistakes. I sold it at let's see, so I bought it 58, sold it 23 something. So there's my loss. So I have it, all the information there. I'm going to record what the loss is, and then I can look at it and see when I bought, why I bought, and then I even can take notes. So I can learn. So I can learn what, you know, what worked, what didn't work, and what maybe I can do better, right? So if you're not doing that, it's a really bad thing. And now, like, go back to the psychology of trading. This is like a 70% loss on a very small position, but it's a 70% loss. What, you're supposed to just ignore that? Like, you need discipline, and you need, that's the one thing why, like, most people aren't successful traders, is because when it gets tough, like, you have to be really disciplined about it, and you have to be able to just take getting punched in the face. And then you have to think about how you were punched in the face. And then you have to kind of fess up to, like, well, you punched yourself in the face. And most people won't do that. And that's why they get into positions where they just lose. And we have so many people right now that are just in a sticky position, and they believe the Fed will bail them out. But the Fed will get, if they get in a situation where that consumer price inflation starts ticking up, even just the rates being up, they're going to have to do something. They've, you know, you got to understand, if you look at shadow stats and you look at all that stuff, like, they've done so much to pull down the cost, the inflation numbers that they use. They've already done all this hedonics and all this stuff where they do substitution. Like, if a steak is too much, then they stop using steak and use hamburger or whatever it is. They've done all this different stuff. Why did they do that? They did that because they know that if they were measuring inflation the way they were back in the 80s, that we'd have much higher inflation, right? And they don't want that because they don't want it for, number one, COLA, cost of living increases on Social Security. It costs the government boatloads of money. And the second thing is it will freak out the market. If you realize that your average returns, like for the stock market, or something like, 5% or 6% a year, or 10% a year, and then, but then if you realize, oh, you got 2% inflation, that's not bad. You're netting a real return of 8%, right? Okay. But what if real inflation is 7% or 8%? Then you're getting like a 3% return. What if, what if it's higher? Then you have an actual negative return. You have bonds that, you think these bonds are really, this is in BIPs or whatever. So it's actually like 1.6%. If you think you're actually earning 1.6% on those bonds, you're probably not, because the rate that you're getting based on the coupon, et cetera, is 1.6%. But the problem is, what is the inflation rate? I mean, think about this right here. This bond right here, 1.6%, and the Fed's trying to get to 2% inflation. Therefore, this is the negative interest rate, right? So they're saying that, hey, 1.6%, I'm getting 1.6%, but inflation is 2%. So I take the 1.6% I'm getting minus the inflation. So what is my real rate of return? My return above inflation is minus 0.4%. Okay, so yeah, so here I want to show the yield curve. And so if you look here at the yield curve, so this basically what this is, on the left axis, the Y, is the yield on the bond, and then the right axis is the length. So like 3-month maturity, 2-year, 5-year, 7-year. So if we look at the 10, you can see the 10 is about whatever it is. It's the 1.6% or something. Is this a log? It's a really weird graph length, so that's unfortunate. But yeah, it's basically the 1.6%. So as I was saying, if the Fed wants 2% inflation rate, and you're only getting 1.6, you have a real return of minus 0.4%. So you take and say, I'm getting 1.6% right now, subtract the inflation rate of 2%, and I'm netting minus 0.4%. So I am losing money on those bonds. Now, the only reason I can buy those bonds is if I can sell it for more. But if I can sell it for more, that means that the price has to go up and the yield has to go down. So do you see how this works? See how the Fed has shot themselves in the foot? They've literally shot themselves in the foot. They said, we want 2% inflation. And not only that, we're willing to let it run hot. And then people are like surprised when the 10-year comes up to 1.6%. I mean, you're kidding me, right? It's still a negative real rate of return on that bond. I mean, it should go up. It should go up to at least 0%. So the yield on the 10-year treasury should be 2% at least. I mean, why? You're losing money as it is now. And of course, what is the dynamic here? The dynamic is what? Oh, the dynamic is that this is what you would call a doom vortex from Gammon. See, the problem is, as the Fed says, oh, they want inflation going up, well, that naturally has to put some pressure on the people that are buying or owning bonds. They're like, look, I don't want these things, because like I said, if I'm only getting 1.5% and that's what I get, and the inflation rate is 2%, I'm losing 0.5% purchasing power every year. That's a huge amount of loss of purchasing power. So I don't want the bond, so I'm going to sell the bond. So the price goes down and the yield goes up, until the point where you can get to some kind of equilibrium where people in the bond market start saying like, okay, it's worth buying that bond. So you can imagine, I don't know what it is. I mean, to me, if I was going to buy a 10-year bond to sit on it, I'd want 5%. So that would mean that would put inflation at 2%, real return of 5%. I would say, let's put the bonds at 7%. That would be reasonable, right? That would be totally reasonable. But of course, if the 10-year basing everything off that, like car loans, everything else, the economy would just shut down. So, so this is rather amazing. So let's go back to summarize. So first of all, you got to be really careful. I'm not calling for any kind of crash. I mean, like I said, I'm not financial advice, but I just have the slow stuff, just sort of the general indices, have tried to hedge a little bit and have some money, little play money. That's it. Because, if you're sitting there and you're looking at your account and you're like, oh, you're down 10% today. I'm sorry, you're doing something wrong, you know, and you know it. You know it because if you just look at the S&P, if you had all S&P 500 spider ETFs as SPY, you what? You wouldn't have lost diddly. All right. Well, that's it for this one. Later.